Hey, what's up, you guys? This is your quick cram session on monetary policy. This one might take a few more minutes than what the fiscal policy one did because there's a lot more involved with monetary policy, right? So let's jump right into it. So, monetary policy, remember, that is the ability of the Federal Reserve to control the supply of money in the economy. Fiscal policy talked about the government and its ability to impact the normal business cycle. Monetary policy talks about the Federal Reserve and their ability to impact the normal business cycle. So, Federal Reserve monetary policy affects the amount of money that is out there in supply. So the whole idea, though, is, it kind of works along the same way. When the economy is not doing well, the Federal Reserve has certain tools at its disposal to give the economy a little bit of a kickstart. Whenever the economy is doing too well, we need to cool the economy back down. We want to try to stay as nice and even as we possibly can. We do not want to get to a point where we have, massive, economic activity and then followed by a huge drop. So here's what we want to do. Remember, the whole idea here is to say, okay, how healthy is the economy? Our economy depends on a large amount of buying and selling. People need to spend money for our economy to do well. So basically, we want to look at what do we do with these tools that we have. And if you don't remember exactly what all of these are, you might want to go back and look at your notes. And if you don't have them in your notes, you need to let me know. So let's look at in a depressionary period first, okay? Whenever we're in a little bit of a slump, we're in a little bit of a depression, what do we want to do with monetary policy? And again, the whole idea here is that if the economy is not doing well, we want more money in the hands of people. We want them buying houses, we want them buying cars, we want them buying jet skis, whatever. If people start to spend money, then our economy should start to come out of the little slump that we have. Okay, so what are we going to do here? The reserve requirement. That is the amount of money that banks are required to keep back. So that in terms of like how much of the total amount of deposits they have are they required to keep back. We are going to lower the reserve requirement. We don't want banks to keep a whole bunch of money on reserve whenever the economy is not doing well. We want to get as much money as possible, not all the money, but as much money as possible in the hands of people to spend it. The discount rate. Remember, the discount rate is to a bank what the interest rate is to you. The interest rate that you pay on like your house or your home loan, it's like the fee for you to borrow money. The discount rate is when a bank needs to borrow money from the Federal Reserve. The Federal Reserve charges the bank a discount rate. So we want to encourage banks to be borrowing money. We want to have those banks lend out that money. So we are going to lower the discount rate. We want to make it cheaper for banks to borrow money. Also, like interest rates, we want, as the Federal Reserve, we want to look at lowering interest rate. That is an awful, awful arrow. I'm using a mouse for this, which is probably not the best. It would be best if I had a stylus, but I'm doing this on a desktop. So anyhow, we want to lower interest rates. We want to make it cheaper for people to borrow money for houses, cars, jet skis, etc. Now, government bonds. Remember that we did this example where I gave you a little piece of paper. It's an illiquid asset. It has value, but you can't take it and spend it. Cash, you can take it and spend it. But remember, if the economy is not doing well, we want people to have money in their pockets so that they can spend it. So bonds, if I'm the Federal Reserve, I am going to buy. Boy, this is like painful. I'm going to buy bonds from you, the American people. You have this bond. You can't spend it. You can't take it to Walmart, or you can't spend it at Amazon. You can't spend it, at Kohl's or anything like that. But if I buy that bond off of you, you sell me the bond, I buy it off of you. You give me that illiquid asset, I give you cash. Hopefully you will spend that cash, and that will get us to come back out of this. Now, basically everything that I just said with when the economy is not doing well. We want to give the economy a little bit of a kickstart. It's the exact opposite whenever we are in an inflationary period, whenever the economy is doing great. Usually when the economy is doing great, lots of people have jobs, lots of people have paychecks coming in, lots of people have money, and whenever people have money, people want to spend money. But when that happens, prices start to go up too. Too much inflation is bad for the economy. So, and we're seeing that right now. I mean, we're at like a 40-year high of inflation right now. It's not very fun. So basically, anything and everything that we can do to discourage people from spending, encourage them to save, and take money out of circulation is what we are going to do. So we are going to raise the reserve requirement. We are going to raise the amount of money that banks are required to keep back, that they are not allowed to loan out. We don't want more money getting loaned out and keep on making the economy go up. That's what will lead to this, and we don't want that. Okay, that's no bueno. So we are going to also raise the discount rate. The amount that banks are going to pay, to that fee that banks are going to have to pay to borrow money from the Federal Reserve, we want to discourage them from borrowing money. We don't want them to be lending it. We are going to increase interest rates. We are going to make it more expensive for people to buy houses. If you want to buy a house at 7% interest rate, you can. It's a bad idea, but you can. Now, in terms of government bonds, again, I am going to sell. If I'm the Federal Reserve, I am going to sell you a bond. Okay, you have all this money, all this cash that is out there in circulation. The more cash that is out in circulation, the more prices go up. So I'm going to, sell you a piece of paper that has value, but it's an illiquid asset. You can't spend it on something. You give me $100 right now, I sell you that bond, and later down the line, I'm going to buy it back from you whenever the economy starts to cool down too much. And then your $100 that you gave me, I'm going to give you $150 to go and spend. That's how it works, okay? So that's monetary policy in a nutshell. Sorry it was a little bit longer. If you have any questions, please, please, please come see me. Send me an email, whatever, okay? Thank you guys so much. We'll catch you in the next one.